Hey everybody, we're going to get started today. I am going to flip us off of our presentation as we get started, so our people can turn their audio on and come in and chat with us. We've got a number of people who've signed in today. I do want to go over some logistics that we need to have. One is if you've got some Q&A questions, go ahead and send them in the Q&A at the bottom. If you'll see it at the very bottom of the screen, that'll come up, and we'll get to those as we can today. So if you've got a question about the current topic, I'll probably interrupt our panelists and let them know that we've got a couple of questions for them. If it's something that they haven't covered yet, we'll save that for the latter half of the program. That being said, if you, Peyton and Brandon, you guys can go ahead and unmute yourselves and come on in and join us. And then Kelly, if you want to go ahead and give the intro from the Commerce Lexington side, feel free to do that. And we do have a few other people who are signing in right now, so it may be just a second before we flip over to some others.
Okay, well, I just wanted to say good afternoon and thank you all for joining us today. This 4 o'clock focus event is a new event that we started with the intention of sharing best practices and lessons learned from various businesses and experts to help our member businesses just during this unprecedented time of going through a pandemic. Our panelists today are Peyton, Tierney, and Brandon Gaines of Todd Gaines, Integrated Wealth Planning, a division of Northwestern Mutual Wealth Management, and they are going to focus on best practices for finances, investing, and retirement. We're seeing a lot of our members addressing the challenges due to COVID-19 of these types of issues. So we thought this might be something that would be beneficial. I did want to say one thing before we get started. In case you weren't aware, this week, Commerce Lexington, to assist businesses with the reopening process, we've created an introductory guide to reopening a business in the era of COVID-19. So it's a really great resource that kind of puts together stuff from the governor and business recommendations and things like that. So if you want to check that out on our website, we're hearing some really good comments that it's helpful. And with that, I will turn it over to our moderators, which are Bill Dotson with Rocker, a technology consulting firm, and Debbie Green, a strategic marketing consultant with Bringing in the Green, and they will moderate the rest of the event. So thanks so much for joining us.
Kelly, thank you so much. We, again, we're in our week 4 of the 4 o'clock focus, and I think that when we started this, we had no idea how much this would be appealing to people and how the registrations have continued to increase each week, and we really appreciate the attendance and the opportunity to just share the best practices and learn from each other so that we're not constantly reinventing the wheel. So today, Kelly's right, we're very fortunate to have 2 distinguished speakers, Brandon Gaines and Peyton Tierney, and they both have well over 10 years of experience in financial planning and wealth management, and they have been taking some additional steps during the pandemic to really stay in touch with their existing clients, serve as a resource for questions during times when people have a lot of concern or potential concern. And so they're kind of going above and beyond with regard to helping their clients work through some of the hardships they may be facing, or just even just general questions. They also are going to share with us some business-to-business tips. And then, of course, as Bill mentioned, if you all have, we have a few questions that have already come in, and Bill and I will take turns, asking those. But if you have additional questions, please continue to ask those through the webinar feature. So with that, I'll turn it over to Brandon and let you guys get started.
Awesome. Well, we appreciate you having us, and we're happy to share on the topic of what to expect going forward with regard to finance. And as Debbie mentioned, we're going to talk a little bit today about what's going on, how that affects people on a personal standpoint, how it affects businesses, and really thinking forward into the future for retirement, what may be different going forward that, 3 months ago, 6 months ago really wasn't on our radar. So we'll try to keep the talk short and sweet, as we know that when we've done these in the past, that the Q&A is the best part of it anyway. So I'll just jump right into it. So I guess I got to start the slideshow. Okay. So 2020, you've got a situation where you've got an unstable stock market. A lot of investors don't realize, at least at the beginning part of this pandemic, how unstable the fixed income markets were, the bond markets. And there was a period of time where there was actually a liquidity squeeze within the municipal bond market. And with the actions of the Federal Reserve creating the liquidity that was needed and that was necessary, we don't have that issue. But it could have been a really big deal. You've got exponential unemployment. I would have never imagined in my lifetime that over the course of a couple of weeks, you would have seen the unemployment numbers rack up that we've seen. You know, you've seen stimulus for both personal and business. And just so Peyton and I can mention this, that we're business owners as well. So we're in the same boat that, you know, we were working with our accountants, working with our lenders, trying to get in line for SBA loan, for the PPP loan, you know, dealing with some of the same issues that I'm sure that everybody on this call is dealing with. You know, you've got really historically low interest rates. And I believe that most economists, most investment managers, most financial professionals are shocked that here we are, you know, over a decade later, and we're still in this low interest rate environment. And people are wondering what's next. And as Debbie had mentioned, that Peyton and I, with our clients, spent the first couple months of this on the phone and doing these Zoom and GoTo meetings. And we realized that people are in one of three camps. They either don't know what to expect. They hear mixed things, and they don't know if life's going to return to normal in a month or two, or if we're going to be re-quarantined again, or what the health or the financial outlook will look like. And we've got some clients that are really worried. We've got some elderly clients that are maybe compromised from a health standpoint. We've got other clients that are just concerned about the health of their family, their relatives, and concerned about the economy and what this means for them going forward. And then we've got other clients that have looked at us that have said, is this an opportunity? Is this something that I should consider going forward in terms of making some moves today that I may benefit from 3 years from now, 5 years from now, 10 years from now? So we hope to kind of address all three of those. So personal best practices. You know, one of the things that we've been working with, at least with clients on the personal side, is budget and cash flow analysis. I believe that is crucial before anybody wants to just jump into the market. As in the first month or two of this, we had some clients that just wanted to take a knee-jerk reaction and go buy Carnival Cruise Lines or ExxonMobil or Delta Airlines or one of the companies in the sector that have been adversely impacted by this. And so the first thing that we've done with all clients, whether they're retirement clients or whether they're 10 or 15 or 20 years out, is just make certain that we're looking at their existing budget, their existing cash flow. If they're in a spot, as we work with some people in healthcare that have been adversely impacted by this, dentists, certain physicians, certain other clients where their businesses have been, you know, temporarily stopped, they were really looking at ways to be able to, at least on the personal side, in addition to their business, reduce their overhead. And for a lot of us, we're not traveling right now. A lot of the discretionary expenditures are not there that maybe were there 6 months or a year ago. So really, it's not cutting out discretionary, it's cutting down the recurring expenses. And so where we've seen people find success is maybe looking within insurance. That's one of the first places that I've advised that clients look, whether they work with their property and casualty insurance agent as ways to be able to reduce or shop out their coverage. You know, we're helping folks look at their and evaluate their life, disability, long-term care insurance program to make certain that if there's a way to cut costs that we could do it. You know, they're looking at some of their other reoccurring expenses that hit their credit card, like their internet, their TV. They're figuring out what they need and what they don't need. Huge opportunities within debt. As we've mentioned, with how low rates are, we're working with clients trying to figure out ways to be able to refinance. If they're really in a bind, maybe increasing that amortization schedule, kicking it out a little bit into the future to really drop the payments. We've had other clients that have maybe kept their payment the same, but been able to reduce the terms of years on their personal mortgage or on other debt. You know, maybe ways to be able to get creative within their cell phone and, you know, merge family members onto a family plan to be able to try to reduce overhead. So trying to manage recurring expenses to, if we do have a client that's in a bad spot, to be able to try to reduce that overhead, that personal overhead, as much as possible. And in the same token, we know that I read this morning that, you know, Lowe's exceeded their first quarter projections. And I know that a lot of people are taking this as an opportunity to do home improvement projects. And we believe in terms of kind of the personal practice, it's balancing that and prioritizing. Is now the time to do those projects? Is now the time to take vacation? Or do we need to get serious about maintaining, as one of my clients calls it, his war chest, his arsenal of cash, and or even thinking about some of the investment opportunities that we may find in the middle of this? Not only is cash king, but cash flow is king. And this has been the first thing that Peyton and I have worked with clients on to make certain that they feel comfortable with. Now, that being said, for those that feel, at least on the personal front, that they are comfortable with their current cash position and their current cash flow, we do believe that there's some opportunities. And I'm going to spend the next couple minutes going through what are those personal opportunities within the markets. The first thing that we've done for every single client that's, as I've mentioned, wanted to buy ExxonMobil or whatever the security is we've advised that we go to look at their existing allocations. So if we look at all the retirement accounts, the investment statements, and the 529s and the Roths, and the individual accounts and the transfer on death accounts and the inherited IRAs, et cetera, we've looked at what are their allocations, because most investors that are 10 years out from retirement or longer are holding some degree of bonds. And we've recommended that clients reassess their tolerance for risk. And if they have 8 to 10 to 12 years at a minimum between now and when they may need that money, then now may be a great opportunity to take more risk within the account. So as opposed to taking cash from the bank and deploying it into the market, doing that within an existing account by being able to come up with money to put into stocks by taking it from bonds or cash within an investment account, it's kind of that first personal practice that we want to recommend that people do to really be efficient with their money and not necessarily have to cannibalize their emergency savings or their liquidity. The second point has been funding future contributions today. So I was talking to a client recently who puts $300 a month into an educational account. And this was, I guess, in March. So he had done $900 of the $3,600 that he's going to do throughout the year. And we recommended that he go ahead and, over the next coming months, if he has the cash to do it, go ahead and accelerate that $3,600 and just put in the remainder of it while the market is down. So again, as opposed to trying to time individual companies or sectors, really thinking strategic about what can I do to take something I was planning on doing anyway and maybe just accelerate that today. Once we've made it through kind of those two boxes and checked them off, we're really looking at tax management. And this is something that a lot of our clients have been concerned about. The day that the government printed a couple $1 trillion worth of debt, our conversations thereafter changed, where a lot of our clients that assumed that taxes could be higher in the future assume that that may happen sooner than anticipated. And with what's going on in the marketplace today, it makes Roth or Roth-like investing a lot more attractive, knowing that in the future we have access to some pool of money that would be tax-free. So on the tax side, we've talked to clients about ways to either be able to get more money into Roths, whether that's the traditional way by funding a Roth IRA, or whether they're able to use what's called a backdoor Roth, which is a non-traditional way for somebody that has a higher income to be able to actually get money into a Roth. We've talked about Roth conversions. So if somebody has money in pre-tax, either IRA or 401k, being able to go ahead and pay the taxes on part of that now, to know that in the future that money will grow back tax-free and will continue to compound in the future tax-free. For certain investors, that may be a really good idea, especially in a year where their income could be down given the COVID pandemic, and also at a time where the investment account that they're converting could be down. So Roth conversion is something that maybe has been on investors' minds over the last couple of years that should be considered today, as well as what's called tax loss harvesting. And this is a concept that will only work in a non-qualified, or what Peyton and I mean, a non-retirement account, an investment account that either you own yourself or you own with a spouse, to be able to liquidate some of the securities that are underneath their cost basis that are underwater, take a loss on paper while simultaneously reinvesting back into something else. So the IRS allows an investor to be able to do this as long as they're buying something that's dissimilar. So they're not buying the same thing. So the example that I always give clients is if you had $100 in Coca-Cola and it fell to $30 and you immediately sold it and took that $70 and you put it into Pepsi, that would be different enough to claim a $30 loss on paper. but to know that the money that you have is in something that's similar that hopefully will grow back. And so tax loss harvesting is something that we've worked with our clients to be able to, during the middle of this downturn, hopefully create some losses on paper without losing money, to be able to help them out with taxes. And I'll circle back to, if we've had a client that's made it through those personal practices that still wants to be able to buy and take advantage of the down market, I'll go back to what Warren Buffett recently did, where he actually sold some of his, all of his airlines holdings, and some of that at a loss, as a lot of people know, to the tunes of, I think it was $6.5 billion. And if picking these depressed values is not good enough for Warren Buffett, these depressed stocks are probably not worth owning individually for most investors. Most investors, if they want to get into the market right now, really need to think broad. They need to make certain they're spreading their money across multiple sectors and hundreds, if not thousands, of companies, because it's going to be very difficult right now in the midst of this to pick clear winners and losers. And so if we're doing any investing for clients, we're not necessarily advocating to buy what appears to be attractive. We're saying, look, if the broader market's down 15, 18, 20%, depending upon what day that you look at it, that's attractive enough. That doesn't happen that often. 20% only happens every 6 to 7 years. That's a good enough of a buy to buy broad and know that if you hold that 1, 3, 5, 10 years, you're probably, as Men's Warehouse, you're going to like the way that you look, as they say. So that's kind of been some of the things that we've been working with clients on the individual side with regard to business and best business practices. We've had a lot of clients with a lot of conversations, with our business owner clients and working through this. Certainly a lot of frustration around working with their accountants, figuring out, how do I get PPP money? How do I apply for it? If I didn't get the first wave, am I going to be on the second wave? And an interesting quote that I heard that Mark Cuban say maybe a month ago is he said, how companies treat their employees during the pandemic could define their brand for decades. And that's so true. We believe as business owners that this is an opportunity to show employees that we care, and maybe an opportunity to potentially recruit new talent. And certainly we want to retain the very best and brightest people that we have. So I want to talk about a couple of those points. So in terms of business to business, I think it's a great opportunity to work with the businesses that we already work with and under promise and over deliver, and know that during the midst of this, we're going to do exactly what we said that we're going to do. We're going to do it on time. We're going to do it efficiently and effectively, and to make certain that we're continuing to keep a high touch service model. That may be also what allows us to be able to expand our B2B on the other side of this as we hopefully get through this pandemic. For a lot of the businesses that we're working with, where there's just an unknown about what the future holds, it's being able to manage cash and manage debt. So much like on the personal side, we have business clients that are getting with their bankers to be able to try to refinance any debt that they can at these attractive interest rates. We have a lot of business owner clients that are hoarding cash to be able to at least survive, or to be able to make hopefully investments or improvements in the future when they feel better about cash flow. And so for a lot of them, they're not necessarily jumping in and doing a whole lot today. They realize that this is a war of attrition, that if they're still here in a year and a lot of their competition or some of their competition may not survive, that they're going to be much better positioned. We believe, at least at our firm, that communication to employees is paramount, and that we want to be very transparent that right now we don't have all the answers. We certainly don't know what to expect in the future, but you're going to have a job. We're going to continue to pay you. We can't guarantee that things like retirement matches, vacation, bonuses, these things that we want to be able to offer to employees are going to be there, but we want to give them our full faith that we're going to do everything that we can to survive and get through this. And we believe that employees appreciate that transparency. Certainly, we want to make certain that those are the things that we cut before we cut salary. Although a lot of employees are already wired to believe that bonus and certain other ancillary benefits they have are part of their salary. But in terms of trying to control expenses, we know that that's the last thing that we want to do is try to cut salary or potentially furlough employees. We also know that during this pandemic, having our staff work remotely has made us realize that we can allow flexibility. It's okay that an employee works from home. They can still be productive. And we've tried to do everything that we can to ensure that employees know that going forward, there will be flexibility. And so we believe that that's a great way to be able to reward employees or show them that you care. is by being able to continue to provide some of the flexibility that we provided during the first month or two of this, ongoing indefinitely into the future. And that benefit is free. And in fact, in the future, it could be that all of us as business owners are reevaluating, do we need the office space do we have? Do we need some of the overhead that we have when we know that we can now work remote and everything can somehow survive? We also know that a lot of us as business owners and a lot of us that run businesses are somewhat resistant to change. And that we know that going forward, we're going to have to embrace technology. Bill Gates once said one time that unless you're reinventing your business model every 10 years, you're going extinct. And I think that that's so true today, that I believe that the true winners that come out on the other side of this are going to be those that embrace technology, those that were not resistant to change, and those that could see around the other corner to say that we may have to potentially in the future operate and run our business model different. You know, we're already looking within our firm as we expand our team. Do we have to have physical bodies in our office? Is there a way that we can potentially have employees work remote, or even employees that we hire in other parts of the country that continue to be a part of our team but don't necessarily have to be in our location? And that brings me to the last point on this hunting for talent. I don't think, at least I've been doing this for 13 years, that there's been a better opportunity to be able to hunt for talent. Because there's a lot of people that had good things going, that were not necessarily looking to make a change, that were kind of running with the status quo, that both personally and professionally have had their life turned upside down the last couple months. And if we're a business that wants to be able to grow and expand on the other side of this, I think what a better time to be able to hunt for talent than today. And so we believe, at least going forward, that it's a great time to be able to snatch someone from another company where maybe they're not following these best practices, they're not transparent, they are not communicating with their employees about what they're doing to be able to keep them there and give them that vision of how they'll continue to grow in the future. So we believe it could be an opportunity to potentially snatch some key people or some really talented individuals that have just become dissatisfied with everything going on, or maybe don't have the confidence and faith in their current company. So certainly on the business side, opportunities that we see, both not only in growing the business, but also in being able to grow those key people that help us continue to grow our businesses. Yeah. On the retirement side, and this is,
I want to add something real quick. Sorry. That all this is new to everybody. And I think that where a lot of people are going to get in trouble or might potentially get in trouble is they use their emotions. And I think that it's a great opportunity for people to pause, to make sure that they talk to an advisor, whether it's us or if they have another advisor, but just really to get another opinion and just kind of relax, because so many people don't understand exactly what's going on right now. Just like I said, because nobody's ever had an opportunity to go through this. So you need to take emotion out of any big move.
Absolutely. Unfortunately, emotion is one of those things that can wreck even the best laid out plans. And so I couldn't agree more. So the last thing we would talk about, and then we'll open up this for questions, is really the retirement of the future, what that looks like. And, you know, as a society, retirement is really a newer thing. You know, when Social Security was first enacted in 1939, I believe the life expectancy for males was 67 and a half. So that's a great deal that you paid into this for all these years, and you lived 2.5 years and died. It was a good deal for Social Security, and that's why it was at one point well funded. And so as you got into the late 70s, it was in 1978 that the first 401k plan came about. And in the 70s, 80s, and 90s, that really you saw that big shift from traditional defined benefit pension plans to what we call defined contribution plans, where you're setting aside money and bearing the own risk of your retirement. And it was really at that point in the 90s that some of the first studies were done about retirement income planning. So I think about this in two phases. Most individuals only think about the accumulation side, which is half the equation. It's the phase that anybody that's not in retirement that's on this call is in. But there comes a day where we cross over to what we call decumulation or distribution. And that is, how do we take the various assets and income streams that we have to be able to mesh together a plan that hopefully withstands volatility, is an all-weather plan, and will last as long as we last. Much more simplistic when it was Social Security and a pension, and Peyton and I call that mailbox money, where probably it would be our grandparents or great-grandparents that would show up at the mailbox, get their 2 checks, deposit them, and they didn't really worry about some of the things that we're seeing retirees worry about today. So the research that was done on this looked back over the 20th century, and it said that if you looked at any 30-year period with a U.S. portfolio of large U.S. stocks and intermediate bonds, that you could withdraw 4% of that portfolio and never run out of money over a 30-year period. And this was a famous study that was done. We call it the 4% rule. So every $1 million could kick off 40,000 regardless of the market climate of when you looked at it during the 20th century, and know that 4% was the worst case. In fact, there was one period of time where 10% would have worked. So that allowed investors to think, okay, I can withdraw 4% and be okay. And the question that we pose is, does that hold up in the 21st century? You know, this is the third major market movement that we've seen in the last 20 years, and we're in a much different environment than what we were in 1990. So the issues that people may be facing going forward that are different is certainly higher tax rates. Most of our clients are planning to know that they could be paying higher tax rates. They could potentially be in a similar tax bracket in retirement and paying much higher tax rates. But we believe overall you'll see some bracket shift. Federal income tax rate's been as low as 10%. It's been as high as 93.6%. We're today fairly low on that, 100-year average. Could be a lot higher in the future, and that definitely will impact purchasing power and spending going forward. Healthcare increases. The biggest year-to-year increase of any retiree is healthcare. The 3 biggest weights within the consumer price index are healthcare, cost of housing, and education. And most retirees have a paid-for house. They've educated their kids. So the main thing that they're seeing inflated every year is their cost of healthcare. Also, Social Security. What does that look like going forward? With what's going on today, I heard a recent estimate that said that by 2029, the current Social Security trust could face some huge issues with the lack of planning that they had around potentially a pandemic that would cause less tax revenue and less funding going into it going forward. So what does that potentially look like for retirees? How do we plan for Social Security in the future? Stock market volatility. If you look at the daily market volatility index of the daily movement within the market, and I know that the news mainly reports the point movement at the Dow, but what I'm talking about is the daily percentage up and down. That's moving almost twice as much as what it did on a day-to-day basis in the 20th century. And so market volatility on a day-to-day basis is escalated today as what it was at some point in the past. I think the biggest issue are the next two, which are, first, when these studies were done in the 90s, they assumed substantially higher interest rates than what we see today. So if you have that traditional, half and half stock and bond portfolio, but half of it is earning hardly any return, hardly any yield because it's invested in bonds and treasuries that aren't paying anything, how do you navigate 30 years worth of spending? You're also in a situation where when interest rates will rise in the future, the value of bonds could potentially go backwards. So if you had to dip into your principal, you may be selling bonds at lower values than what they once were, which most investors correlate bonds with safe. And we try to explain to clients that bonds are not safe. They're just not as risky as stocks. There's still risk there. So this flat interest rate environment that we may be in for a while, where the tail could be rising, could dramatically impact somebody's retirement longevity, increase longevity. So today, if we have 2 healthy 65-year-olds that are non-tobacco users that sit down with us and they ask, how long are we going to live? We're looking at joint life expectancy, which is the probability that one of them is still here in the future. There's a 59% chance that one of them is still here at 95 and a 28% chance that one of them is here at 99. So we got a 1 in 4 chance of a 34-year time horizon of them still being here and consuming. And that's a big problem, because when you take low interest rates, you take volatility, and you take a 35-year time horizon into that equation, you're going to have a lot of portfolios that could potentially fail at a 4% withdrawal rate, which that's not a very high withdrawal rate. And you've also got, the rise and fall of U.S. equities. The 20th century was a great time for investing in U.S. stocks. And just to put it in perspective, in 1975, the U.S. made up 60% of all the world's GDP. Well, today it makes up 40%. That's flip-flopped. And I can only imagine going into forward that there's a lot less growth opportunities within this country as there may be overseas. So if we're not investing overseas, we're not investing in 60% of the world's market. And we believe that all of these issues, from taxation to longevity to market risk to inflation to healthcare to long-term care, are causing people to rethink the planning puzzle. And this retirement of the future could look a lot different than what the retirement 20, 25 years ago looked like. So those are some of the things that we're seeing, and a lot of the advice and the planning work that we do with clients is around how we plan for a totally different phase than what we could have ever imagined in the year 2000.
That's great, Brandon. Thank you so very much for that thorough overview. I know, Bill, you said you had a couple of questions that have come in, and I know we had some that were submitted prior. So, Bill, do you want to go ahead and ask a few?
Yeah, I was going to say, hang on one second. What I would love to do is, Brandon, if you'll turn your screen share off, that'll put everybody on the screen.
Yes.
And again, for those of you who are with us, I would love it if you sent your questions in through the Q&A. So one of the things that I'm really curious about is we've got a situation right now where it's probably really causing a lot of people to wonder what they're putting their money into the market for. So a couple of years ago, I heard this concept of, I don't need to be 65 to take many retirements because I can always go back to work. What portion of your clients are completely thinking about changing their model from the I'm going to work till I'm 65 and then I'm going to retire to I'm going to live, and every now and then I may work or I may have that mailbox money or whatever it is, but I'm comfortable taking a more relaxed work environment because I want to live in the event something like a pandemic occurs, and it could be one that does start to affect people who are in that area where they're not in that super sensitive health range. So somebody who's 35 to 55, they're okay. They can start doing these things. How many of your clients on a percentage basis have thought, I don't want to wait till I'm 65 or 67 to retire. I want to do periodic retirements and I'm willing to go back to work?
That's a great question. I'm glad that you mentioned that, because what we're seeing now is that's the new norm. So if you told me what percentage of people want to model in kind of an untraditional approach, whether it's what you mentioned, Bill, where I'm going to, at 62, I'm going to take a year off and then I'm going to work for 3 years, take a year off, or what we see, which is more common at 60, when my kids are out of college, I want to plan to go part-time or do consulting, and I'll do that for a while, and that'll be kind of like a semi-retirement, and then at some point later, I'll fully retire. So I just relate this concept to a stoplight. It used to be, the old school thinking was you had your retirement party on a Friday, and on Monday, you're sitting at home watching The Price is Right. And now you're really seeing this kind of green light, yellow light, red light phase where there's somewhat of a reinvention. And so to answer your question, I would say the majority of the plans, 60% of the plans that we're running today for clients are people that are wanting to model in non-traditional ways to approach this, whether it's, taking a sabbatical. I'll give you an example. We have a physician household where they wanted to, at 58, quit their jobs and work for Locums, which is an independent contracting group for physicians. And so we assumed that they cut their incomes in half, and that one of them worked 5 years and the other one worked 10 years. They were the same age, but one of them wants to work longer. So we modeled in this phase of what we're going to do and save and invest for the next 8 years to get them to 58. And then we're not going to save and invest anymore, but they're going to make enough working half time to be able to cover their bills. And then at some point in the future, it is, I've allowed my assets to grow. Now they're going to produce an income. So I would say a lot of people nowadays want to see this. How do I model whether it's covering a year? So, thinking more along the lines of having multiple buckets. And what I mean by that is short-term reserves, mid-term, still having retirement assets. So therefore, at any given time, if they want to take a sabbatical or if they want to model in this yellow light phase, their investment and financial plan allows them the flexibility to navigate a pandemic if it occurs in the middle of it. I mean, I think cash is king. And I think what this has taught a lot of clients is that there is a value in having non-market correlated assets because bonds necessarily aren't it. Bonds went down. Having cash or something like cash that can bridge the gap if they are in the sabbatical or if they are early on in retirement so they don't cannibalize their investment portfolio and sell it when it's down.
Yeah, we have one of the things that I look at is our only true currency. There are two, time and health, and money helps with those. But if we really
Absolutely.
think about how many summers we have left in life, do I really want to work until I'm 65 to take that vacation for the rest of my life? That I'm seeing more and more people who are frankly bored and they're going back to work just to have something to do. I'm sure there are plenty of people who are having to do that because of a drop. Luckily, not like 2008, but something similar to that. I did have a question for you, Peyton. You mentioned earlier the emotional response, and we do tie money in our retirement and this concept of this is what I'm working for. And it has to inherently be emotional unless you have so much money that isn't an issue. So I'm curious how many, when all of this started to happen, how many of the phone calls did you have where you were kind of calming the waters saying, let's wait and see what happens? And then how many people just said, I'm out. I want to go do something different.
Well, and that's a very good question, Bill. We had a few phone calls where people were anxious, and we kind of had to talk them off the ledge, so to speak. But really, we just kind of go back to, we have a plan in place, and this is the reason why we have a plan. And just what Brandon was saying, this is the reason why we have the buckets of money, short term, your midterm, and your long term. And just really reassure them that everything's going to be okay. As a lot of us have heard the saying that this too shall pass.
Yeah.
We had a client call us probably a month ago, wanted to take a significant amount of cash value out of their policy because they wanted to buy oil stock, because they said that oil's at, it's going to be somewhere around $10 a barrel. It's got to go up to 40 by the end of the year. So, and that's kind of pigeonholing yourself. And we said that's not a good move at this point, and just like what Brandon was saying about diversification and going broad in the market. So, but yes, emotion has a lot to do with what people do.
And how many people have approached you with, and I, forgive me for the term, I don't know it, but I know you were able to pull a certain amount of money from retirement right now, some without penalty, but what I'm more interested in are the alternative investments that you can do. So everybody talks about the market, but I know you can pull money out of either a Roth or an IRA or something to even invest in small businesses that they believe in. Are you seeing any activity in that area where people are looking for alternative investments?
Absolutely. We've had several clients like that one that wanted to invest in specific sectors or industries. We've had other clients that maybe wanted to use this as an opportunity once the real estate market resets to maybe capitalize and catch some stuff on sale. So you're right. We have seen clients say that they want to kind of diversify outside of just the traditional stock and bond model to look at some of these alternative categories. Interestingly enough, we've also had other clients that have liquidated real estate holdings or sold a business that wanted to get into equity. So we've seen it actually go both ways during the middle of this about trying to create more diversification and know that we don't have all of our eggs in the same basket, as they often say.
Yeah, that's a good point, because there could be someone who's already doing something different. They see the dip in the market, they want to come in and try to time it, which I know you probably, there's a little element of the timing that we hear is okay, but most of the time you dollar cost average. Am I correct in assuming that?
Correct. I mean, certainly we've advised that people take advantage of the market being 20% down plus, depending on the day that you look at it. But over a long period of time, I agree with you that we do want to spread it out. We do want a dollar cost average. But, the other thing that we found, I wanted to make a comment on the business to investment thing. It's been really interesting is I have found that those that aren't heavily invested in real estate want to be, and a lot of those that are older that are don't. And so it appears to be that in terms of the world of savings and investing, the grass is always greener. We have clients that have millions of dollars of real estate holdings that get to 65 and they just don't want to mess with it anymore. And other clients that's all that they want to do to get to that point. So I believe that in that old saying, everything in moderation, it's important to be well balanced and know that not everything's in your primary business, not everything's in the stock market, not everything's in cash, and not everything's in real estate.
Well, I will confess I have a personal question. What
Sure.
do you do with your commercial REITs right now?
That's a good question. So, I mean, I think one of the things that and we talked a client out of investing in a commercial office building right before this happened. He hadn't banked us yet, but hopefully he will at some point. Because you're right. To your point, commercial real estate may fundamentally change. But I think you could also, just like everything, if it seems doom and gloom, there's usually a reinvention. You know, I take, for example, what happened with the summit that I'm sure that a lot of people have read over the last day, that it looks like there's going to be some things changing within the summit barn, but it's not dead. It's just maybe potentially flipping around and being able to reinvent it. I've seen this in my wife's hometown, where a part of a shopping mall that closed has now become a surgery outpatient center. And that's going to help boost business to the remaining stores that are open. So I think within commercial real estate, I guess if it's pigeonholed, Bill, to answer your question, to potentially office buildings in a certain location, maybe that's not necessarily a good thing, but the value of a REIT is hopefully that you're diversified across multiple sectors, because certainly I don't see Amazon going anywhere anytime soon. And if you can invest in warehouses and other type of industrial commercial, you know, we see a lot of manufacturing coming back with some of the supply chain issues that we've seen over the last couple of months. So maybe it's not all doom and gloom. It just depends upon the sector within commercial real estate.
Okay. Well, one other question from me, and then I'm going to turn it over to Debbie. I feel, Debbie, sorry, because I have all these questions while I've got these guys here on the phone.
That's great.
So if you were if you're looking out the window one day and you're thinking, okay, where is all this headed? Because not only, I know you guys get advice from analysts and from different firms, and you guys have your own. What if we have a rebound effect with the coronavirus? Things are opening up as we speak. We know that there's more testing than ever. And let's say a month from now, we have more confirmed cases, the number of deaths increase. And I hate to be doom and gloom about this, but it is something that we all need to factor when we're talking about investments. What happens then? And by the way, I'm sure there's some gambling site that probably is offering, you know, something that you can bet on that's going to happen. I don't know what the odds are going to be, and nobody else does, but what happens if we get to July and the numbers they've gone down for a little while, but then they spike again? Any advice there?
Yeah, so I think you have to look at this in a couple different ways. You know, there's the healthcare concern, which we were all originally told that we were flattening the curve to be able to not overrun the hospital system. And I know my wife is a physical therapist in the hospital. I've got clients that work in the hospital. I know that has not even come close to being the case. And so I agree with you, Bill, that there is a risk, and there most likely will be a resurgence. Hopefully it's not extreme. If there is a resurgence, what we've kind of foreseen is that it may be more geographical than necessarily a total shutdown. So you could see potentially parts of the country, certain cities, certain towns that are shut down, or certain industries or sectors that get affected more so than maybe a total United States, nobody's doing anything lockdown. You know, if that happens, at least we've been through it once before. And the other thing is that the Federal Reserve and the Congress is willing to jump in and do everything they can to keep liquidity in the system and keep the economy going. So in terms of the markets, we believe the markets and the economy are going to kind of move slightly differently and independently. I see the markets being headed in the right direction long before the economic data backs it up. And by the way, that's what happened in the great financial crisis, that the market bottomed in March of 2009, but unemployment didn't peak until September. So the exact same thing happened then, where the economy did not look good. The market kept going up, and everybody was waiting for the W or the V or the U or whatever the letter is that they use to refer to the correction. And so I think it could be much like this. Hopefully it's not as bad. Could be terrible. Could be that we don't have fall sports this fall, which as a football fan, that'd be disappointing. But I do know if you look back in history, in 1918, you've got the end of World War I. The Spanish flu comes about, kills, 50 million people across the globe in 3 months or whatever the statistic was. And then over the next decade, you had the Roaring 20s. So you saw up to that time the greatest economic expansion and creation of wealth that you'd ever seen. So as Warren Buffett said in the recent Berkshire Hathaway annual meeting, don't ever bet against America. That's a losing proposition. We'll somehow find it out and figure out a way. And that, again, that circles back, Phil, to that diversification point that we can't pick individual winners and losers because we're not necessarily dealing with an economy. We're dealing with a healthcare issue, and we have no idea how that's going to affect it. So I think market timing and security selection is a lot more difficult now than it is during a non-pandemic. So if you're broadly diversified and you've got the time to hold it, I think you're going to end up being okay.
Okay, that's great advice. Well, Debbie, we are. I know you may have a question or two. I know we're getting close to our time, but if you've got these questions, I know the people who are on may want to know the answers.
Well, actually, I appreciate that, Bill. I think actually we may just go ahead and wrap up because the very last question that we had that Brandon didn't address was kind of talking about the diversification in real estate in particular. So he pretty much just addressed that. So we really appreciate all of the engagement and all of the very thorough information that you guys prepared for the webinar today. I think it's good to end on a note of don't bet against Americans, right? Something very positive. Just to kind of give the attendees a little bit of a preview, we have 4 more weeks of the 4 o'clock focus. And so Bill and I have been working with Kelly and Liz and the team at Commerce Lexington to continue to try to provide relevant topics. We know that definitely in the future, and maybe next week or the week after, and we'll let you know very shortly, we are going to be focusing on technology security, and especially understanding as we move into where we are partially remote and partially working in an office, what we can do to keep employees integrated through technology. And also, Bill works regularly with companies over the last 4 to 8 weeks that have kind of already solved for some of these issues. And so he'll be able to give us a little bit of a sneak peek and sneak preview into what we can do to save you guys time as you are business owners trying to solve some of these issues. We also plan to have an advertising and marketing seminar where we're going to feature best practices from a messaging strategy standpoint. Last week, we got some great ideas on tactics that businesses should be spending their advertising dollars in, but I want to go into a little bit more depth on messaging strategies. And then I just finally, last but not least, really encourage you all to fill out the survey that Bill will send out after the webinar and give us some ideas for any topics or speakers that you all would like to see. So once again, thanks to our panelists. Thanks to Bill. Thanks to Peyton. And we look forward to seeing everybody next week at the 4 o'clock focus.
Yep. Thank you all. Have a great night.
Take care.
Thanks, Bill.
Thank you.
Thanks, Debbie.
Bye-bye.
Thank you.